Well, hello, everyone. Welcome to the Accounting for Impact, the intersection of financial and ESG reporting webinar. We're excited you're here with us today. My name is Stephanie. I'm one of the enrollment counselors with the online program supporting Ohio University. This session will contain 30 minutes of information along with a brief Q&A at the end. Please feel free to post your questions in the chat as we go along today, and we'll take time at the end to answer those for you. Today's webinar is hosted by Professor Jennifer Sesterick-Stevens. Professor Stevens is an associate professor in Ohio University's School of Accountancy and the program director for the Master of Accountancy and Coming in the Journal of Accounting and Public Policy, Accounting Horizons, Research and Accounting Regulation, the Journal of Portfolio Management, and the Journal of Investment Management and Issues in Accounting Education. Jennifer teaches accounting theory and application, as well as forensic accounting and fraud examination in Ohio University's Masters of Accountancy and Analytics. She also participates in interdisciplinary forensics team at Ohio University and team teaches Introduction to Forensic Studies. As we go through the presentation today, again, please do not hesitate to leave questions in the chat and we'll answer those at the end. With that, I hand it to Professor Stevens.
Thanks so much, Stephanie. I'm really happy to be with everyone today. Thank you for joining us. I am going to talk today about a topic that is very important to the future of accounting, and that's accounting for impact, the intersection of financial and ESG reporting. I would like to introduce myself. So I am the program director for our Master of Accountancy and Analytics. I have a background in, I have a master's degree and a PhD in accounting. I also have significant work experience in forensic accounting. And so I think you will find that with most of our professors here at Ohio University. We all have a lot of industry experience. We're all CPAs, and we really bring a lot to the classes that we teach. So before I get too much into financial and ESG reporting, I just want to talk about accounting in general for a minute, because I want to challenge you to think of accounting a little more broadly today. So I want you to think of a scenario. Let's say we have two drug companies, and coming out of the pandemic, I think we can all envision this scenario, right? We have two drug companies, Company A and Company B. So Company A has promising clinical trials. They are investing in new cutting-edge R&D technologies. They're attracting and retaining top talent. They're buying new plant and equipment to mass produce drugs, and they're paying their suppliers in a timely manner. Then we have Company B. They have not so great clinical trial results. They aren't really investing very much in new technologies and R&D. Their talent is underpaid with high turnover, and they're selling off plant and equipment to cover their debt payments, and as well as not paying their suppliers in a timely manner. So each company needs $100 to stay in business. We only have $100. How do we determine which should get the money? So I think all of you would agree that we should allocate that $100 to Company A. And so this is why accounting is so important. It allows those companies that have, promising operations, are investing in our future, to get the required capital that they need by communicating that information that they have internally to external participants. And so this allows society as a whole to collect this relevant, reliable, and comparable information and make decisions based on it and help allocate these scarce resources that we have efficiently and effectively among competing needs. And in addition, it's allowing companies and the society to really avoid waste and enhance efficiency. So we have some of the most efficient and effective capital markets in the world here in the United States. And I attribute that to the very strong reporting and regulatory environment that we have around financial reporting in the United States. So when we go back to the cancer drug scenario that I just gave, when I team teach my forensic studies course, and that is an undergraduate course, but it's team taught across a lot of professors, many from the arts and sciences. I stand up at kind of toward the end and I tell the students, you may not think that accounting is helping to cure cancer, but I am going to argue that accounting is helping to cure cancer by helping allocate that money to those companies that have the best cures for cancer and are investing in those drugs. And so you may say that accounting doesn't help cure cancer. I disagree. Accounting does help cure cancer. So again, my colleagues in the arts and sciences kind of laugh when I say that. But I want you to remember that accounting really is the language of business. But I want you to think about accounting more broadly. Accountants really are information specialists. And so while data analytics is the most recent buzzword, and big data is a very kind of more modern buzzword, really accountants have been dealing with big data for decades. And we've been doing data analytics for decades. What we do is we take all of this disparate data and we turn that data into useful information for decision making. And up until this point, it's been mostly financial data. However, accountants actually work in many, many areas of the business. So think about Medicare claims or payroll data, even employee performance or balance scorecard. And now we're getting into sustainability metrics. And so anything that needs measured and reported, accountants are really good and can critically think through these issues, think through what data is needed and how we get data that is reliable, comparable, reportable, so we can make decisions based on that data. And it's not always just business data, right? You will always use this. You will need these skills in your personal lives as well. So, like I said, traditionally, accountants have been focused purely on financial data, but really because accountants are information specialists, and in business, people realize that accountants understand all areas of the business because we see, for the most part, everything that comes through the financial reporting process. We take all of those events, right, and we create, summarize them, create metrics and measure them and put them into reports to be used in decision making. So while we've traditionally been focused on financial data, we are moving toward a more broad-based view of business and economic activity. So now it is not only the financials that matter, it is the overall impact on society, on various stakeholders, maybe, and not only investors and creditors, but other potential stakeholders as well. And so accountants are really ready to tackle this challenge of moving the financial reporting system from a purely financial reporting system to an overall business reporting system that's going to include the financial aspects as well as the non-financial aspects. And so if we think about the future of accounting, it is really bright because we are really well prepared and well trained in these areas that are going to need to be measured and reported. And so, we had the former chair of the IASB say the future of financials is non-financial. And then we had someone else, these are three very famous authors that said the future of ESG is potentially accounting. And why could the future of ESG be accounting? Because you can't manage what you don't measure. So if companies are going to need to be undertaking, and by ESG, I mean environmental, social, and governance initiatives, they are going to have to find a way to measure those initiatives, to manage those initiatives, and report those initiatives to the various stakeholders, both internal and external to the organization. So accounting is going to play a very key role in the future of the environmental, social, and governance initiatives that are being undertaken by businesses, organizations, and governments. So here's a little bit, here's kind of a nice graphic from PwC that helps you better understand what is ESG? Well, it stands for environmental, social, and governance. Here we have the environmental pillar, and that's going to be focused around climate change, natural resources, pollution and waste, and environment opportunity. Then we have the social pillar. So here we have human capital, product liability, stakeholder opposition, and social opportunity. And then lastly, we think about governance, corporate governance, board diversity, ownership, accountability, transparency, anti-corruption. initiatives. So really, ESG is very, very broad. And the good news is, you know, a lot of accounting already is incorporating, has already traditionally incorporated a lot of these governance areas, covered that, you know, through the 404 SOX reporting and all of these disclosures that go into the 10K reports issued by companies. And, you know, we do have, again, around Sarbanes-Oxley, we had a lot of new corporate governance initiatives. So we have made good progress in the governance area. But I think what is going to be upcoming in the future is a greater focus on the environmental and social pillars. So here is kind of a summary of the traditional financial reporting system, right? It had a very economic focus. So we had the real world, right? We have all these economic events, and we put those economic events into our accounting system. And the three steps kind of the accounting system, where we are going to identify those events, we were going to measure them, and then we are going to communicate those events in a manner that gives relevant information for decision making. And those within the accounting system, traditionally, and to identify and measure those events, we relied on accounting rules. So generally accepted accounting principles would tell us which events we are measuring and then how to measure them. And then it would also tell us how to organize those into some type of reporting, into some type of report, right? And those reports were our general purpose financial statements with our balance sheet, our income statement, our statement of cash flows, our notes. We know the notes are very important, the auditor's report. And then for public companies, we also had, you know, the additional disclosures around the 10K and the management discussion and analysis. The creators of the rules were the FASB, the IASB, and you know, the regulator in the United States is the Securities and Exchange Commission that regulates all companies with publicly traded securities. So though that relevant information was really focused on kind of two sets of decision makers, it was focused on those internal, for the financial reporting, it's more focused on external, right? But managers might also need information. So then we have some managerial accounting, but really for our external decision makers, for our traditional economic focus, we're focused on those investors and creditors. So those people putting equity into the company and those holding the company's debt. So either bondholders or private lenders like banks. However, we are now kind of moving to an expanded accounting system. And so we're talking about a new accounting system that has a triple bottom line focus, some are calling it. So we'll have all of these real world events, but now we're not only going to be focused on the economic events, we're going to be focused on the environmental and social events as well. And so that is going to go into the accounting function. And that is going, again, the accounting function is evolving. So it is, you know, we're going to have to figure out which events need to be reported and included in the measurement and reporting system. How are we going to measure those events? And then how are we going to communicate those? So what does that, how do we take all that data, measure it reliably, and put it into a report that provides relevant information for those decision makers? So is it a general purpose sustainability report? Some companies are putting out these general purpose sustainability reports right now, and they are separate from the 10K or the financial reports. Some think that we are going to a holistic report where it will be a dual purpose financial statement that will have not only the financials, but it will also have all the environmental, the ESG aspects built into that one report as well. And we're really moving from a purely, the economic stakeholders, meaning the investors and creditors, to looking at a broader array of stakeholders when we're thinking about who needs this information and, you know, what information do they need? And so we're not only thinking about the investors and creditors, we're thinking about governments, we're thinking about employees, we're thinking about citizens of the planet. And So we are, again, as we think about the demands for information, who those demands are coming from, it helps shape the reports that we decide to create. So the accounting system is evolving, and it is a very exciting time to be in accounting. So if we think back, I just wanted to give you an example about how we might think, how do we start to think about measuring and reporting some of these ESG events? So the easiest one to think about potentially could be the environmental pillar. So this is a rapid, it's an economic, environmental, social, and governance, but this is a rapidly changing regulatory environment around ESG. So unlike financial events, no US regulatory entity exists that will provide some type of gap specifically for environmental and social events. I'm going to talk a minute about this rapidly changing regulatory and reporting environment. But the EU is actually further along than we are in the US, and they have a new corporate sustainability reporting directive that is going to require reporting around ESG for companies doing business in the EU. And that is going to apply not only to publicly traded companies in the EU, but it is also going to apply to privately held companies of a certain size that are doing business in the EU. So this may be, even if you are a private company in the US, if you are of a significant size and you are doing significant business in the EU, you may have to comply with the reporting requirements that have been set forth under the CSRD. So for this ESG reporting, I've been talking a lot about the external reporting, but remember, we have accounting systems for internal decision making as well. And so we are going to have to evolve our internal accounting systems to also capture and measure these environmental and social events that are occurring within organizations. And so this is going to, again, these internal decision makers need help in determining and in supporting the decisions and their strategic, their strategic process. So strategic decision making. How do you decide what segment to invest in? How do you decide what country or area to put a new plant? How do you decide which product should have which pricing? So all of these strategic decisions that are occurring within companies need information to support that decision making. And so our ESG is going to need to be increasingly incorporated into our internal systems as well. Sometimes we have some reports that are issued regularly. Management wants to monitor these every single quarter. Sometimes it may be for one-time use or projects. And then from the external reporting, we already do have some reporting requirements in the United States that may encompass some of the ESG. As I mentioned, we actually do have a lot around the G, around the governance. But for example, if we have some very large contingent liability, so we have a site and it potentially needs to be remediated after we leave that site, and there's going to be an environmental liability associated with that. That is already disclosed in the 10K or in our financial our GAAP financial reports, and also under the risks and analysis, environmental concerns and increased regulation. Increased regulatory risk is already probably listed in management's discussion and analysis. So that is kind of the current state of the required reporting around ESG. But we also have a lot of voluntary reports that are occurring right now around ESG. So I would say the lion's share of reporting around ESG is currently voluntary. So if you go to any company, a lot of times they're going to have an environmental impact report or an ESG report. These are voluntarily put out by the company, and they are not consistent. They are not the components of the reports are not consistent. The metrics that they are including are not consistent across companies. They may not be consistent across the same company or across different years within the same company. And they are measured in different ways. So the problem with the voluntary reporting regime is that companies can cherry pick what and how they report. And so right now, this is a risk as companies are putting out all of this information. Some are referring to this as greenwashing. So companies are putting out all of this great information, but it hasn't been audited. The information may not be reliable and it may not be trustworthy. And so the SEC is starting to get involved. So the SEC is going to have a new rule. It's going to be purely related to the E. It's around climate-related disclosures. And as I mentioned, the EU is already further ahead in some mandatory reporting that I mentioned under the CSRD. So when we think about the reporting in general, the measurement can be very difficult. These events, it's going to take time for us to learn about all the different events that should be included and how to measure them. And we don't have, or we haven't had one set of standards to provide guidance on how to measure these. So we have US GAAP, right? Generally accepted accounting principles to help guide financial reporting, but we don't have one, and we do, of course, have the IFRS, right? International Financial Reporting Standards. So we kind of have two major financial reporting sets of standards, but we don't have the same thing for environmental ESG disclosures. So that is a rapidly evolving space, and I'm going to talk about in 1 minute. So that is a challenge, right? How do we measure these identify and measure these activities and events, especially when we don't have one standard yet? How do we report these? What does the report look like? Is it going to be regulated? Is it going to be mandatory? Or are we going to continue under some type of voluntary reporting regime? How do we audit these? So auditors, we're going to have, more room during the audit, or a separate, a different group that's going to audit these. And then we also need to think about, if we do go to a mandatory reporting regime where we have, standards as far as how to measure these events, which events to include, how do we report them? Are these reporting requirements causing any unintended consequences, or what incentives are they encouraging or discouraging? And so, we sometimes think about, we've had some major frauds in the past where the FASB, the accounting rule says, here is a bright line. So the company manages right below the bright line, right? So we need to think about some of those unintended consequences or these incentives when we are creating the standards and formulating the regulatory regime. And then we also need to think about that cost benefit trade-off of reporting. This reporting is going to be very expensive. And so we need to make sure that the benefits to this reporting are outweighing the costs. And I think that as a society, as a global community, we are moving in the direction that these, initiatives, these impacts matter. And so they need to be measured and reported in a reliable way. So if you just think about how difficult this can be, I want you to think purely about the E and about the GHG emissions. And so in the United States, we are moving potentially to have these reported depending on the new SEC rule. So the question is, which GHG emissions do we measure? And then how do we measure them? And so we have, for GHG, greenhouse gas, we have kind of three scopes: a scope 1 emissions, a scope 2 emissions, and a scope 3 emissions. So if you think about it, the scope 1 emissions are the direct emissions from the company. So these are, the emissions from their facility or their fleet that are the greenhouse gas emissions that are going into the environment. And then the scope 2 emissions are any indirect energy usage that they're purchasing from the large, basically utility providers. So here they're purchasing electricity or steam, heating and cooling for the company's own use. So scope 1 companies seem to have started to get a pretty good handle on. Scope 2 is measured a lot of times by the big utility companies, and they're giving some measurements to the company to be able to provide. But then there's something called scope 3 emissions, and those are emissions related to all parts of their production process, all the way from each piece of raw material to how the end consumer uses that product. So this is the entire supply chain. So a level 3 emission is getting at all of those emissions that the company touches through its entire supply chain. So any fuel or energy related in any, used in mining or creating any of the raw materials that go into their production process. Even their employees, commuting into work counts as a scope 3. And then if you think about the kind of downstream activities, how, are they selling those products? How is the end consumer using those products? How is when that product is disposed of? What types of impact on on the environment might that have? So the level 3 emissions are extremely complex and very difficult to measure. And so I think that the experts in the area we're still trying to get in kind of a handle on how to measure these. Is there going to be double counting of emissions because one person's raw materials, another person's final good, etc. So the good news is we have had some consolidation in reporting frameworks. So we used to have a lot of different reporting frameworks, but very recently, as of like a couple days ago, even, we have had several of the big frameworks that have merged together into the International Sustainability Accounting Standards Board. Most recently, the Task Force on Climate-Related Financial Disclosures, TCFD, is going to be kind of subsumed by the IASSB, so the International Sustainability Standards Board. So this is part of the IFRS Foundation, and it basically started out as SASB, the SASB standards, and they have been now purchased by the IFRS, or acquired, I guess would be a better word, by IFRS, and they are going to be coming up with IFRS sustainability disclosure standards. So the old SASB standards are going to be renamed or kind of, acquired by the IFRS sustainability disclosure standards. So it appears now that we are going to have, an International Sustainability Standards Board, and we already have, some standards under that board, under the SASB. And they are going to, further incorporate this, elaborate on these, and make them more formal into IFRS sustainability disclosure standards. And then they are going to talk about, they are going to help, another initiative is going to be an integrated reporting framework that is going to help companies kind of integrate all this information into usable reports for decision making. So I'm a little short on time. I'm going to just briefly mention, so while the EU and Europe is a little bit, the IASSB is a little bit further ahead, the SEC is moving in this direction. We have a new rule expected out, likely in October. We've seen a proposed rule on climate-related disclosures. This note is only the E, it's only environmental, it's only climate-related disclosures. The SEC realizes that we do need some, consistency and regulation around this reporting. It is likely to require disclosures of scope 1 and 2 GHG emissions, is the current thinking. It is unlikely to require financial statement recognition. So that rule is unlikely to require these to actually be reported, as a line item on the financial statements. It is more likely to be a note disclosure. And the final rule is expected this year. And we were thinking it could be April, but we're hoping now that it is October. So if this topic interests you, I think that, there is a bright future in accounting. And I'd just like to talk a minute about our Masters of Accountancy and Analytics program. We have a fully online program. We have very dedicated faculty here at Ohio University. So our faculty, you get the same faculty that teaches in our residential program that you get in our online program. And our faculty really attempts to recreate that hands-on personal touch that we have in the on-campus setting in our online setting. So we get to know our students on an individual basis. We get to understand their career goals, and we try and help them meet those career goals. We do hold live interactive classes every week. So this is not a, an asynchronous, do it all on your own program. We are there to guide you and help you. We are very proud of our case-based curriculum. So when we designed our Master of Accountancy, we actually designed the same program for the on-campus and our online program. We designed it around a case-based curriculum. We think that really helps students learn the material and be able to apply it right away and hit the ground running when they start working. Of course, we will help you. Our degree will help you meet the requirements to sit for the CPA exam, but please check with your enrollment advisor. We do meet the requirement in almost every jurisdiction, but just to make sure we meet your individual state's requirements, please check with your enrollment advisor. And we are a very efficient program. You can be done in a little over a year, depending on your background. And if you come from a non-accounting background, we do have a path for you that is going to be extremely efficient and get you done, quickly as well. So we have designed our program so that you can enter our Masters of Accountancy program and work toward your CPA based on any undergraduate background. So you can have an undergraduate degree in accounting, or you don't have to have an undergraduate degree in accounting. We have created 3 tracks based on your undergraduate degree. If you have an undergraduate degree in accounting, we have an accounting track. If you have an undergraduate degree in business, but not accounting, so maybe finance or marketing or another business degree, we have a path for you. And then if you are coming from an undergraduate background that is completely non-business, maybe one of the sciences or engineering, we have a very efficient path for you as well. So for our accounting track, you can come in again with an undergraduate degree in accounting, and it's 7 core accounting classes and 3 electives in data analytics. We designed this program to be very heavy on the analytics because we believe this is very important to the future. And again, accountants are really good at analytics, and it is a very kind of key skill set for their toolbox. So you get to choose 3 electives in data analytics taught by our data analytics faculty based on what's available when you need them. Now, if you're coming from a non-accounting background, we do have 4 accounting foundational courses. So these are prerequisites that are basically going to get you up to speed to take your master's level accounting courses. The good news is you don't have to get an entire undergraduate degree in accounting. We took 30 hours of accounting or 24 hours of undergraduate accounting and condensed it into 4 prerequisite courses. So we call it the best hits of an undergraduate degree in accounting to get you up to speed so you can take our master's level courses and get prepared for that CPA exam. So, and then of course you'd have our 7 core accounting courses and 3 courses in data analytics. If you're coming from a non-business undergraduate degree, you would take the same 4 prerequisite courses, the same 7 core accounting courses, the same 3 electives in data analytics, and then we require 2 additional business courses that we think will be helpful to you so you better understand business and the application of accounting within business. We are a case-based curriculum, but we have, again, adapted our curriculum for the working professional. You take 1 class at a time online. Classes are 7 weeks, so you can really focus on 1 class for 7 weeks, and then you get to move on to the next class. We find this really helpful for busy working professionals that have families and jobs and lives. And we have found that this it really helps our students be successful as opposed to taking full 14-week courses. They take 2 7-week courses as opposed to the normal 14-week course and where you would take 2 a semester. There are so many opportunities in accounting. So I think sometimes people think of accounting as bookkeepers. We are not bookkeepers. Most bookkeepers don't have a degree in accounting. So we are training you for the future, for those critical thinking skills, for dealing with business problems. How do we use data to solve business problems? And, in the end, it does all flow through the accounting system. If you don't generate cash, you're not going to be in business very long. So we are not only poised to help address the needs of the future from an environmental, social, and governance perspective, but we also are extremely well versed in helping companies be sustainable long-term from a financial perspective. So we have 3 starts a year: fall, spring, and summer. And if you have any questions, please, reach out immediately. You are always welcome to contact me or any of our enrollment team at this contact information.
Wonderful. Thank you so much for all of that information. I think we've all learned a little bit more about how this program will really benefit what's changing and developing, especially when it pertains to ESG. We do have one frequently asked question. You did a wonderful job covering the first question that I often get, which is about the program tracks and how students are going to benefit from those. So that was fantastic in the presentation already. But one of the questions that we do get or have gotten recently because of the new name to the program, we've added the and analytics. Would you tell us a little bit more about what this means for students?
Sure. So we actually have always had those analytics requirements in our program. And so we just renamed the program to reflect the underlying curriculum and skills that our students are going to be acquiring in the program. And this is really, we think that our program is unique in that we are teaching all of, some hot accounting topics, but we are also cognizant that the tools that we are using are changing, and we want our students to be very well versed in those tools and new approaches to data and data analytics, because again, we see ourselves as information specialists, and that's going to be increasingly important as we start to tackle more than just accounting information financial information. So we think that employers, while the opportunities in accounting are endless. So my boss likes to say, if you get a degree in accounting, I can promise you that you will always have a job. I can't promise you that you will like your job, but if you don't, I can promise you that there are 5 other jobs out there waiting for you. So there are so many opportunities in accounting. And then there are also so many opportunities in analytics, but pure analytics is so broad that if you couple that, knowledge of data and data analytics with the very specific financial accounting skill set, it is really a highly desirable degree that is going to open many doors, not only immediately, but well into the future.
Wonderful. That is so helpful to have that clarification. I'm not seeing any other questions in the chat, so I think we can begin wrapping things up. So I do want to just thank everyone again for joining us today. We hope you've received some great takeaways and learned a little bit more about today's topic and how this program can help you with that. We'd love to hear from you with additional questions for our team. So please feel free to reach out to online admissions at 740-924-5725 or email us at getstarted@ohio.edu, and we'll connect you to an enrollment counselor. Thank you all again. Have a great day.
Thank you, Stephanie.